We are kicking off with the latest from the logistics world. Covenant Logistics Group just dropped fresh quarterly figures, giving us crucial insights into freight demand and pricing. We dive deep into what these new numbers mean for the U.S. trucking and logistics stock, and which specific freight trends investors are watching right now. Signaling serious supply-driven inflation. Finally, we shift gears to agriculture. Wandalsi Lobo at Nampo shared a mixed outlook for South African farming in 2026, highlighting challenges like disease and infrastructure decay, while pointing toward potential growth in field crops and fruit exports. Stay with us for the full breakdown. Covenant Logistics Group has released fresh quarterly figures and provided critical insights into current freight demand and pricing trends, offering investors a clear view of the U.S. trucking and logistics sector. The company, which operates as a truckload and logistics service provider utilizing both asset-based trucking fleets and non-asset freight management solutions, has strategically shifted focus toward contract-based and dedicated business to enhance margin stability against spot market volatility. The company's revenue is segmented across expedited truckload, dedicated transportation contracts, and managed freight services. The dedicated business relies on long-term agreements, offering predictable revenue streams indexed to fuel costs and service levels. Meanwhile, the managed freight segment generates revenue through coordinating capacity and optimizing routes for shippers. Management commentary from the late April 2025 earnings release highlighted a challenging freight environment characterized by continued pricing pressure in certain lanes. However, the company noted that its dedicated and contract operations have successfully cushioned the overall impact on financial results. This mix of higher-margin dedicated services versus more volatile traditional truckload freight is a key strategic focus. Key operational drivers include the utilization of the trucking fleet, pricing power on contracted lanes, and the volume of freight managed. Costs remain heavily influenced by driver wages, fuel prices, insurance, and equipment expenses. As freight demand softens, revenue per truck can decline due to scarcer loads, intensifying pricing pressure. Investors are closely watching the company's ability to grow its dedicated and logistics segments relative to spot-exposed operations. This focus on long-term customer relationships is central to Covenant's strategy for securing stable returns. Competition from large national carriers and digital freight platforms is intensifying, but Covenant seeks differentiation through service reliability, niche capabilities, and on-time performance in time-sensitive freight. Regulatory compliance, including driver hours of service and emissions standards, continues to shape the landscape, prompting ongoing investments in newer fleets and telematics to maintain a competitive edge. For U.S. investors, Covenant Logistics Group provides exposure to the domestic freight economy, acting as an early indicator of broader economic health. International investors view the company as a focused play on dedicated services, influenced by trends like manufacturing reshoring and e-commerce fulfillment. Overall, the latest figures underscore that Covenant is navigating a normalized rate environment by successfully deepening its commitment to stable, contract-based logistics solutions. MingZhu Logistics stock, ticker KYG 6222201069, is gaining investor attention following recent company disclosures related to its Hong Kong-based logistics operations and visibility to U.S. investors. The company operates within the logistics and transportation services sector, a business inherently sensitive to external factors such as trade flows, fuel costs, and customer demand across China-linked supply chains. For U.S. investors, MingZhu Logistics is relevant as a small-cap foreign issuer with U.S. market visibility, which implies elevated volatility risk. The stock's performance is closely tied to the operational realities of the logistics industry, where revenue is driven by shipment volumes, contract stability, route efficiency, and broader trade activity. The business model is characterized by exposure to macroeconomic variables. Key revenue streams include freight forwarding, transport coordination, and ancillary service fees. Investors are closely monitoring indicators such as freight demand, utilization rates, and cost control, as even minor shifts in margin structure can significantly impact equity valuations in this niche sector. Analysts and investors often assess whether the company is demonstrating expansion of its customer base, improvements in operating efficiency, or reliance on transient business momentum rather than robust, recurring contract strength. Given its reliance on supply chain activity, MingZhu Logistics stock is highly susceptible to macro headlines concerning shipping activity and demand shifts, particularly those related to China. For U.S. retail investors, beyond the underlying business fundamentals, reporting quality, capital structure, and the consistency of company updates are paramount. Small overseas issuers listed in the U.S. may provide limited information, making verified disclosures crucial. Investors tracking microcap logistics names are seeking evidence of revenue stabilization, customer growth, and improved operating leverage. While the stock offers exposure to a real economy service tied to trade and inflation, caution is advised for investors prioritizing large-cap transparency and deep liquidity. For MingZhu Logistics, balance sheet flexibility, trading volume, and the reliability of disclosures are as important as the business narrative. The core question for investors remains whether company updates can establish a more stable operating picture over time. U.S. freight costs are surging rapidly, with the April 2026 Logistics Managers Index, LMI, reporting transportation prices at 95, marking a significant 5.6-point increase from March and establishing a new all-time high for the index. This surge signals a critical imbalance in the supply chain, characterized by a collapsing capacity-to-price ratio unseen in the LMI's history, raising alarms about supply-driven inflation. Transportation capacity has simultaneously plummeted by 10.9 points in April to 28.4, the second lowest level ever recorded by the LMI. With readings below 50 indicating contraction, the 28.4 figure suggests a severe market contraction. The disparity between the record high prices, 95, and the record low capacity, 28.4, creates a staggering 66.6-point gap, the largest delta in the index's history, serving as a major stress indicator for global logistics. The headline LMI climbed to 69.9, representing the fastest expansion pace since March 2022. Aggregate logistics costs reached approximately 242, the highest level recorded since April 2022. Analysts pinpoint the proximate cause as elevated fuel costs, driven by the closure of the Strait of Hormuz, a vital global oil transit route. This combination of tight freight markets and high energy prices is generating supply-side inflationary pressure that monetary policy is ill-equipped to handle. Survey respondents anticipate continued escalation, projecting the index to reach 73.2 over the next year, suggesting logistics costs could remain elevated through 2027. This supply-side constraint dynamic also impacts risk assets. Historically, Bitcoin and other assets struggle during sustained supply-side inflation due to competing rising yields from central banks. The massive price-capacity gap is viewed as a critical warning, suggesting that the current strain on the physical supply chain could lead to cascading economic effects far beyond the shipping industry. South Africa's agricultural sector is facing a period of mixed growth heading into 2026, according to observations from the largest agricultural technology show in the Southern Hemisphere, NAMPO. The event provided a platform for stakeholders to discuss global trade, geopolitics, and biosecurity concerns alongside the domestic state of farming. The mood at Nampo was generally positive, highlighting technological innovations across seeds, fertilizers, livestock products, and financial solutions. However, pressing challenges were clearly identified. Foot-and-mouth disease in the beef and dairy sectors, and African swine fever in the pig industry were emphasized as significant hindrances to growth. Experts view these diseases as a call to action, stressing the need for improved plant health and enhanced animal health investment. Infrastructure deficiencies also place considerable pressure on the sector. Inefficiencies in logistics, poorly managed municipalities, and deteriorating road networks across provinces like the Northwest and Free State illustrate governance challenges impacting business operations. While port efficiency has improved, challenges at the Port of Cape Town negatively affected table grape producers, prompting collaboration between Transnet, organized agriculture, and the private sector to enhance efficiency. Despite these headwinds, several subsectors showed strong performance. Field crops and horticulture are upbeat, with plentiful expected harvests. The 2025-26 summer grain and oilseed harvest is estimated at 20.8 million tons, showing a slight year-on-year increase. Fruit products are also performing well. Export volumes from stone fruit and pome industries rose by 12% year-on-year, and table grape exports increased by 3%. The poultry industry also experienced a better start to the year, supported by lower feed prices for maize and soybeans. Looking ahead to 2027, significant risks loom. Higher input costs for fuel and fertilizer, driven by the Middle East conflict, combined with the anticipated El Niño drought, could negatively impact the sector and employment. Furthermore, the timing of the grain industry's summer crop plantings in October 2026 coincides with these rising input costs, suggesting that decisions made at that time will significantly influence the sector's fortunes through 2027 and into 2028.